Welcome back to course number 7, Basics of Investing. In this lecture, we're going to talk about one of the most important concepts in investing, risk versus return. Understanding this trade-off is key to making smart investment decisions and building long-term financial success. Risk refers to the chance that your investment may lose value. Return refers to the profit you earn from your investment, such as interest, dividends, or capital gains. The two are connected. Generally, the higher the risk, the higher the potential return. The risk-return trade-off means that if you want higher returns, you must be willing to accept more risk. For example, stocks carry higher risk but also offer higher potential returns. On the other hand, government bonds carry low risk but provide modest returns. Investors need to balance the two based on their goals and comfort level. Low-risk investments such as savings accounts, certificates of deposit, CDs, and U.S. government bonds are considered safe. They provide stability and security but grow slowly. These investments are great for short-term goals or for people who cannot afford to take big risks. High-risk investments include stocks, startups, cryptocurrencies, or speculative ventures. These carry the possibility of losing a lot of money, but also offer the chance of very high returns. High-risk investments are better suited for long-term goals when you have time to recover from potential losses. One way to manage risk while still aiming for good returns is diversification, spreading your money across different types of investments. If one investment performs poorly, others can balance it out. Diversification helps reduce risk without eliminating the possibility of growth. For example, a student investor named Maria put some money into stocks for growth, some into bonds for safety, and some into an ETF for diversification. By mixing investments, Maria balances risk and return and avoids putting all her money into one option. Every investor has a different risk tolerance or comfort level with risk. Some people can handle seeing their investments go up and down, while others prefer stability. Age, income, financial goals, and personality all influence your personal risk tolerance. It's important to match your investment choices with your goals. For short-term goals, like saving for next year's tuition, low-risk investments are better. For long-term goals, like retirement, higher-risk investments make sense because they offer more growth over time. To summarize, risk and return are two sides of the same coin in investing. Higher returns usually require higher risk, while lower risk brings lower returns. The key is to understand your own risk tolerance, diversify your investments, and match your strategy to your goals. By doing this, you'll build confidence and a stronger financial future. This concludes our discussion about the risk versus return. In the next lesson, we will learn about the interest and compounding. See you then.